believe it. Okay, on Thursday I was looking for some shorts, but excuse me, I was away. I had to go to work, so I missed out on this move. But what I was looking at was this huge ass liquidity grab. Excuse my language. Um, but we had nice trendline liquidity building up right here. We had this prominent low, and what the market did, we opened near resistance. So look what the market did at the open. It chopped around, it hit resistance, and then it got bearish structure off of resistance. There was a lot of people buying here at these levels. They people that bought into resistance and held all got cooked because the markets love to grab liquidity. There's so much stop losses lying under here. So once we got this rally, so if you track structure, we have this low, this high, new lows, new high, a new low. We couldn't break this high, so it's we're in session. It's volume time. We're hitting resistance. So once you get that first pullback and you get a move away, that's an official support zone, and you have a new high. So if you start getting price action signals at a resistance point during session with volume, it becomes very high probability when if you're just reading raw price action, look at these bearish entry signals, candle confirmation signals. You got one bearish signal right there, two bearish signals, three, four. So the way I like to think is, okay, we have an established high at resistance. What is the probability of the market creating a new high? We would need to start breaking the new current high. But if we don't, this is where trap buying takes place, all right? Because there's people buying the support. They're seeing all the support and they think it's just going to keep going higher. But if you know how to read structure and price action, this action right here, this action right here is letting us know price doesn't want to go higher. It's respecting this high currently as of now, and we have support. So you had 1, 2, 3, 4, 5. 1, 2, 3, 4. You had 4 bearish rejection candles. That's 20 minutes of price action to get into a short. So the way I like to think is, okay, rejection, rejection, rejection. What's the probability if we start breaking the lows of a bearish entry signal? What's the probabilities of it traveling lower than higher? I would say the probability of it traveling lower is much bigger. So if we put our short tool here and we have stops at the highs, and once again, the way I trade, I like to target A plus liquidity. Liquidity trend lines is what fuels my way of trading because I know you can visually see when you read a graph, a price action, just any type of graph. You can read where the liquidity is resting. It's very simple. Like if you could draw a trend line, there's money resting below all of these lows. And during session, everything becomes valid in my eyes. So the only risk you need to take is, okay, I'm getting these bearish signals. We hit resistance. It's session time. I have a current high, right? What's the probability of price traveling higher or lower? That's something you need to ask yourself. And just accept the risk. Because now here, if you were to be bullish, it would invalidate that and go higher. But if your trade idea plays out, you're at resistance during session, you have a low. Now this is the lower high. See, price action, when you trade price action, you're literally predicting a move without even seeing it yet. That's why we are called traders. We are risk takers, because you don't know if this low, you don't know if this low is going to hold and then go higher. This is where everybody messes up. This is where decision making is key in trading, and you have to be a risk taker and take on risk to be a to be a profitable trader. So the risk that you need to take here is, okay, I'm getting bearish rejection candles. There is a high probability that this becomes a lower high. And since you're predicting the future of the market, you're betting you're betting on this market to going lower. But in hindsight, no one sees that yet. Everybody trades what they see until they get wrecked. So in hindsight, it's like, oh, we have a low, we have a high, low, let me keep buying. But it's session time, we have resistance. The bears have a motive to push price lower from this point, because in the past we've seen that the bears get aggressive. So you gotta see where the price is landing and the reactions. So in this case, yeah, the market could have made a lower high to go lower, but the price action told you otherwise, that we were rejecting, we had bearish rejection candles, and that it was respecting this current high. Like, it was literally telling you, I'm respecting this high with these bearish price action signals. So that being said, when taking a short, like in this case, my take profits are everything. So if I don't have liquidity, A plus liquidity, I'm not taking anything. So yeah, this was a perfect example of just waiting for that trade to come to you. We have a low, we have a high, we have a low, lower high. This is where everybody messes up, because they don't see it coming. In hindsight, they don't see this lower high coming until it breaks that low. Then when price is here, everybody's like, oh, we're losing now, like big time. And that's the bet. That's the way you need to think. You need to take on risk and accept risk. So in this case, accepting risk, all we need to do is, okay, we have multiple bearish signals. If I get one candle closure above these 4 bearish signals, I'm going to cut the loser short or de-risk the trade, because maybe it's not ready yet. That's key, because you still have your stops up here, but you could easily get out midway. Like if we start body closing above these bearish signals, because that would mean the trade is not ready yet, and that you're going to be potentially wrong on the trade idea for this moment. So that's a way I like to think when managing risk. So it's just betting, even though the stops are above here, you're betting that, okay, if price close above here, I'm going to get out and cut half of the trade off, or cut everything off at half. So if you're risking 1%, you'll only lose 0.5, which isn't bad. If you're risking 2%, you'll lose 1%. If you get a body closure like midway above these signals. But if you're right, you're risking 2% and you're making above a 2R risk to reward ratio. And if you take it all the way down to A plus liquidity, all the way back down to this gap fill. So there's still a gap to be filled, but this was the last liquidity point, and the market filled it into the T, grabbed all this money, and started rejecting and going higher. But once again, the higher time frames are still bullish. This is important, but it doesn't mean that during session you can't take a bearish setup. Again, my way of trading, if I see A plus liquidity, I'm taking it all day. I just need to wait for it to align for me to take it. That's key. So in higher time frames, we're bullish until we start breaking this low, because this low brought new highs. So this is the new prominent low, prominent high. We have this rally. We could mess around here, make new highs. Who knows? Excuse me again. But yeah, that's my way of thinking, my way of trading, and hopefully this helps and enlightens your mind, your trade ideas. Sometimes you just need a little bit of clarity to open your eyes, and yeah, that's about it. I'm out of words right now, but yeah, let's get it. Peace.